Hello and welcome to the live trading hour brought to you by the Live Trade Room. What we look to do during the session is we'll scan the markets. We'll first of all, I suppose we'll look at the market fundamentals, see if there's any major news events that are likely to impact our trading. We'll assess the sentiment. We look at things like bond yield, US longer term bond yields, just to see how those are influencing markets. We'll try to, we'll certainly be discussing sort of market sentiment right now, having experienced last week's FOMC and also yesterday's testimony from the Fed chair. So we'll see how these markets are interpreting this information, and then we'll go through the markets, we'll scan the opportunities, we'll see where the opportunities lie, we'll put our trade plan up on screen, and then we look to execute that trade plan over the course of the trading session. So without further ado, if we could just start, as we always do, with our risk warning. Of course, please take note of the risks involved in trading these financial markets. Without risk, there is no opportunity for return. So do bear that in mind when you trade. But it is therefore very important to almost concentrate and certainly focus on the risk side of trading these markets. If you limit your risks as much as you possibly can and open yourself up for big winners, that's certainly the approach that we would like to adopt. Okay, so let's begin with a review of some market moving news. So again, what we want to do when we trade is just be mindful of any major news events, see how they're likely to impact our decision making. And we've had a series of manufacturing and services data points over the course of the day so far, largely across the European jurisdictions. So we're talking about French manufacturing, French flash services, German manufacturing and services, also EU-wide, and UK manufacturing and the services industry. And I think we're closing off with the US at 245. So how do we interpret this information? What we can do is we can look at the forecast for these figures, and anything above 50 represents expansion. So if we look at French manufacturing, we're expected, the forecast is 59, so well above the expansion, the point at which manufacturing expands, which is 50. So we're easily above that, and we just fell shy of that 59 figure. Similar situation with French services. So expansion was expected 50 to 59.6, and we've actually seen slightly less than expected. So if you compare and contrast French manufacturing and services, and compare and contrast them with German manufacturing and services, you can see that the German manufacturing sector is performing better than the French, and the same can be said for the services industry in Germany. Broadly speaking, the manufacturing across Europe is marginally better than expected, with the services industry just expanding at a rate in line with forecasts. So Europe is doing okay. German economy is performing better with regards to manufacturing and services, certainly more so than for example, the French economy. But all in all, pretty decent performance, bearing in mind the current market environment. Okay, so as we scroll through, so what do we have to deal with today? We've got some retail sales figures impacting the Canadian dollar, so we might experience a little bit of volatility. Anyone trading the dollar, the CAD, should I say? We're actually in the CAD on a bigger time frame, but we'll see if an opportunity exists on a smaller time frame. But actually, if you look at these forecasted figures, we're actually anticipating sort of negativity on that side, so a bit of a fall off as far as retail sales figures are concerned across. In fact, that would be quite a sizable little dip to the downside. So it will remain to be seen whether retail sales in Canada are as bad as forecasts. That's certainly important for anyone trading the CAD. And we're really going to finish the day really with US manufacturing and services. These are performing. The expectations are that the US manufacturing and services sectors is performing better than European. So we'll see if that's the case today. I'm sure we'll get an update from our Squawk service as well, so we'll get some information on that shortly. Just make sure it's turned on.
And an update in Brexit talks here from RT's Tony Conley that the EU is expected to grant the UK an extension of the chilled meats grace period applicable under the Northern Irish Protocol. That's RT reporting.
Okay. Crude oil inventories minus 3.6 million barrels. We've been in this negative territory for quite a while, which it basically helps support the price of oil.
RT reporting the EU is expected to grant the UK an extension of the chilled meats grace period, and noting that both sides agreed a 6-month grace period in December, which is due to expire on July 1st.
Now, the last major news event for the week is tomorrow's BOE, where we'll actually we'll get the votes with regards to either keeping rates as is or look to increase. There's some dissent slightly. Sorry, I always get this the wrong way around. So the first numbers would like to increase. Yeah, the second number would like to decrease the stock of asset purchases, and the third to hold asset purchases where they are. So we're talking about tapering. The Fed are talking about it. The BOC have already reduced their asset purchases by, I think it was 25%, if I'm not mistaken, there a few weeks back. The Fed are now embarking on that little process as well. So we'll see how we get on. Yeah, good afternoon, Finbar. Hope you're well. So that's anyone trading the British pound. Just be mindful that we're going into a major event tomorrow. Okay, so it's really all about manufacturing and services. I suppose what's worth commenting on really is the 10-year note in the US and just seeing, how is this price interacting with these markets. So there always seems to be one eye on the bond markets at the moment, and actually there's considerable softening. That's certainly the view, and we can see that that's quite supportive of stock markets, although the S&P 500 is not doing an awful lot just yet, but we're certainly maintaining these higher levels.
Hitting the main wires now. Cantrip, the EU SEC advising member states that the extension to the Northern Irish Protocol chilled meats grace period should be granted swiftly.
Okay, so let's see what opportunities we have for you today then. So something we've been monitoring all morning is, let me bring this up. So last night in our trade plan session, we were looking for some dollar weakness across the board. We're beginning to see that play out in markets like the Aussie dollar. So our bias is to the upside. If I just get up my pen. Same situation for the euro yen and the pound yen as well. What we'll do is just record these levels just up here. There's a lot of resistance up these highs for the yen, and we're keeping a close eye on the S&P 500 as well. So what we're doing is we're looking for a little bit of a further break to the upside at these levels. These would all play into opportunities to the upside for each of these markets. Okay, so the arrows just indicate kind of what direction we're looking for these markets to move in. One market to keep a close eye on is the S&P 500. Because if we perhaps go in and just check that trade out for a moment, and you look at it on a market like this, you can see that we're, for the majority of the trading days so far, we're kind of in this little downtrend. So we want to see if we can reverse that downtrend if we possibly can, to see if we can get into a bit of a buy trade. It's just not giving us that opportunity just yet. So it's just softening further. What would be an interesting move for this market is if prices actually rolled completely over to the downside.
Looking to an update on the secured overnight financing rate, coming in unchanged today at 0.05%.
So that's a market to keep a close eye on.
An update in COVID easing in Switzerland, as the government saying allow major pandemic reopening measures from June 26 as ease entry requirements.
Right, so I'm just going to put these little directional little candles just in here, just to show, you know, at what we would expect with these markets. So these are largely the markets we're looking at. We're looking at this contrast between risk on and risk off. You can see, just to explain kind of what that is, potentially. So when this market is pushing lower, you're clearly in.
So seeing the US May building permits now revised to minus 2.9% from the initial reading of
I'll just turn that off for a second. When these markets tick to the downside, and the S&P is kind of a good gauge for that, then you're in risk-off market conditions. And what that means is you physically see capital moving out of stock markets, which is a riskier environment for money to be, and you see them flooding into other areas. And some of those areas include the US dollar, as you can see with the moves we saw last week, and also the yen. And they're called flight to safety trades. So we're seeing capital physically come out of markets like the S&P 500 and quite a few of the other ones, which is pushing to the downside, and we're seeing the yen benefit accordingly. So these are market correlations that you should be aware of if you are trading foreign exchange. It is useful to know these things. So when stock markets push lower, we often see capital coming into the yen and the dollar. Now the same is also true. So the opposite is also true. So if we remove, you know, the risk off aspect to this trade and just look at the significant move over the last 2-3 days to the upside in this market, what we can do is we can see money coming out of the US dollar this time and the yen, and as you can see into safe havens like the euro and the pound, and also you would expect to see the stock markets benefit accordingly. So this is why we spend a little bit of time focusing on the stock markets, the indices, the global indices, the big baskets, to just show you in real time, I suppose, the relevant or the relative strength of an economy, and understand how this impacts your foreign exchange markets. So if we're in a risk off phase, then we can expect capital coming into the US dollar and into the yen accordingly. They don't have to move in correlation, but they often do. And the same true is to the upside. So if we're in a risk on market condition, we'd expect to see capital coming out of the yen and out of the US dollar. So they are sort of tradable, really good, decent tradable opportunities in these markets. So I hope that little sort of bubble just kind of makes sense. And today we look at this candlestick in here today, and are we risk on, risk off? We're actually neither. We're just sitting inside a pretty tight range. Just while we're talking about range, the range of today's market is, we've got a high of 42.60 and a low of 42.42. So that's an 18-point range. Now the average, which has been coming down all the time for over the last 20 days, is actually 36. So we can expect, and this is where sort of profitable risk reward comes in, because what we can do is we can expect a 36 pip range, just because that's been the range over the last 20 days, and it's got a habit of kind of repeating itself. So of course things happen which knocks that consensus on the head. But when these markets are drifting sideways, you can often still see an increased range. So the markets might just push up to the upside, and you might get a little sort of impulsive move to the downside. And then something like that might be your 36 pip range. So from 42.70 down to 42.35, so like a 35-36 pip range, very, very easily, although this market is still moving sideways. So and that can help as well with if you're looking for a profitable return. So if you get in with this trade and you've got a 15 pip stop loss, to expect like a 45 point, 60 point, 70 point winner over the course of a trading day, it's very, very unlikely. So and you can use that ATR for that reason, and then you can make a decision whether it's a viable trading opportunity at any given point in time. And right now it's not for us. That's just, I suppose, the reality of it. Okay, Finbar, I don't know if you're still with us, but do you happen to be in any of your particular trades at the moment? I saw the Aussie CAD last night, and I know it was just it was edging lower. So okay, yesterday we did get that little move to the downside, but we were kind of explaining what a rubbish tradable opportunity it is. Most of what this market has been doing for the last month or so is pretty much moving sideways. So a break to the downside would be a high probability trade, or a reversal trade to the upside would be your high probability trade. Yeah, good. So you're still in them. Okay, so the Aussie CAD, yeah, and the Euro Pound to the downside, I assume. Or are you going counter trend? So a little bit of a bounce back, but it's got quite a lot of, ultimately a bearish bias to it, which is absolutely fine. But there's a lot of volatility within there as well. and that's what you get often with the miners. We largely trade the majors. I mean, these markets can be quite volatile as well at times. So this dollar has a bit of a decision to make. So we're strengthening a little bit. The dollar's weakening, should I say, against the commodity currencies, the CAD, the Aussie and the New Zealand. But it's not really doing an awful lot just yet. It had performed quite well against the yen, whereas the dollar's weaker against everything else. So that's why the focus is always on the pound yen and the euro yen as well. So this euro dollar, we'd expect it to push higher. Yeah, dollar CAD short. Yeah, that was a trade we looked at last night below the 122.96. So in a bit of profit in that one, but we've and you can also take into account the crude oil. So that's likely to support the CAD. Just be mindful, we've got a volatile potential retail sales figures out in about 20 minutes, I believe. Let me double check that. Where are we? Yeah, so Canadian retail sales figures. It's expected to be pretty bad, so that would likely to be a little bit of a concern potentially, unless it's not as bad as it would appear. Yeah, so the euro pound to the downside. Okay, so we've got the next leg to the downside then as well. Must have happened quite recently. Yeah, because we had quite a strong little pullback there, back into this level of resistance. Just basically touched the monthly low, and now we're getting kind of an accelerated move to the downside. So good opportunity on that one. I don't know where you're placing your stop loss. You've got a stop loss here around the 85.60 level, but also just probably a few pips higher would probably be marginally better. In fact, maybe a few pips higher than that. So I suppose you've got three options really from a technical stop loss perspective. So if you get in around this little area here and you get a move, you could either have a stop loss placed above these highs, or if you wanted a little bit more distance, you could choose one of these three. So one, stop loss two, stop loss three. The market is so range bound. Yeah, the 86.50. You mean the 85.60? Above this high in here. Okay, let's keep an eye on that one as well. We have been trying to sell this market, but we keep getting these sort of one-off days of prolonged kind of snapback markets, but we continue to grind in the general direction. Gold is still in this sort of long-term range here, and just the S&P, it looks like we could be finding a little bit of support, which could give the dollar weakness trades a little bit of support. What we don't want to see is this market break back below the 42.40. Then the potential for some dollar weakness will begin to subside. You might see some capital coming back into the dollar and into the yen pairs as yet again. Okay, 86.50 on the euro pound. Is it a daily time frame trade, or are you sort of looking? It's just the 86.50 is right the way up here. So do check that the 86.50 is kind of up at these levels. This is on a daily time frame as well, so I assume if you're selling here, you're not using a stop loss that far away. Oh, you are trading the daily time frame. You could probably, I mean, saying that, you know, I think we got stopped out on this particular candlestick as well, with just an explosive move to the upside. So you just got to weigh up the return, you know, the 100 and let's say 110 or 120 pip stop loss might be a bit on the excessive side, but then you'll be in it longer to see sort of further growth to the downside. So it's your shout basically, and you would expect price to be pushing down to the 84.72 level. Okay, 85.75. Okay, so you've been in it a little while then. Yeah, good. Yeah, we're certainly advocates of trading with slightly bigger stop losses at the moment, especially if you look at this price action. It's not that encouraging. So let's have a look at these markets again. Strong rejection of those highs. Yeah, I'm just looking at these markets off screen as well. Small time frames are too much at the moment. Yeah, I completely agree. Like about 4 or 5 years ago, we have in the past traded like tick charts and stuff, but now the high frequency sort of bots and there's trading approaches now that can enter the markets a lot quicker than you or I are able to do. So we're at a very significant disadvantage on the smaller time frames, and the volatility can be quite excessive. So now you're quite right. We use slightly larger time frames. We have been doing that for quite some time now as well. Yeah, that's exactly it, Finbar. So get your thinking process right on the higher time frames. So get your cue from the daily. That's what we've been doing for a long time now. So if the daily is pointing to the upside, you can look for buying opportunities. If the daily is pointing to the downside, you can look for selling opportunities. And you don't really need to complicate it any more than that. And sometimes you can get reversal signals which can get you into the downside. So there's lots of other methodologies, but if you started out with something as simple and as straightforward as that, and as you know, we use daily highs and daily lows as trigger prices. When we get notifications of prices breaking above or below a particular price, then it gives us a heads up, and it allows us to look to get into that trade from a position of objectivity, not necessarily what we think is going to happen, but more so what is actually happening. Prices are breaking above daily highs, daily lows, monthly highs, monthly lows, and all of that is quite useful information. And of course, the more reasons you can stack up to get into a trade, if you're mentally doing this all the time, you can derive at a decision, which is to take that trade to the upside. It'll come, and it will get a lot easier.
So it's over 10 minutes time now to the bottom of the hour as we wait the US current account balance for the first quarter, with a deficit of $206.8 billion expected versus a prior deficit of $188.5 billion. A range seen according to Reuters of a deficit of $210.0 billion to a deficit of $197.5 billion. Additionally, at the bottom of the hour, turning to Canada and retail sales for April, month-to-month minus 5% expected versus a prior of 3.6%. A range seen of -6 to -0.5%. The ex-autos reading for retail sales month-to-month minus 5% expected versus prior 4.3, a range seen of -6.6 to -1.9. A note here from HSBC before the Canadian retail sales. They note that restrictions on essential economic activity are expected to have hit retailers hard in April. That's in late May, accompanying the March retail sales report. StatsCan presented a preliminary estimate that retail sales declined by 5.1% month-to-month in April. So that preliminary forecast was based on a response rate of 46% compared to the average response rate over the past year of 90.7%. So they see many retailers had yet to report their April sales number. Nonetheless, they look for retail sales to drop by 5.1% in April, and given the restrictions on non-essential activity, they expect the largest decline to be in retail sales excluding autos, where they look for a drop of 5.6%.
Okay, so we potentially have some decent opportunities. We've got this Canadian news out in 9 minutes. If you don't mind, I'll just put you on our screen, and I'll be back to you in 2 minutes if that's okay. Sorry, bear with me.